Torsten Slok. Torsten, good to see you.
Thanks for having me, Mike.
You've been leaning in the direction that the economy is in better shape, maybe with more momentum than many had believed. So this jobs report today, certainly better than the forecast. In itself, does it show, in fact, that we are now at a new run rate for job creation and economic growth?
Yeah, because I do think that this is evidence of the tailwinds to the economy at the moment. It is not only the AI spending boom. Let's also not forget that we also have the one big beautiful bill that's playing out. The Congressional Budget Office estimates that that's adding about 1 percentage point to GDP growth this year. So now we suddenly have two engines of growth coming from both what's happening with, of course, the AI boom, but also with what's coming from the one big beautiful bill. And the other important aspect of this report is that this also puts to bed, at least for now, some of these fears about displacement of labor because of AI. It's very clear that job growth is very strong in the initial phase of the build-out, both for data centers and energy associated with data centers. So at the early stages of this AI boom it is actually going to be more inflationary, which creates some problems for the Fed, because we're both seeing now, of course, more jobs being created. We're also, of course, seeing capex, which is very strong. We're, of course, also seeing that labor in the sectors that do construction of energy and data centers is also quite strong. So there's a number of different dimensions in this report that are actually rocking a bit in market narratives that we have had for quite some time.
Yeah, I mean, at least forces the question of whether there are the makings of some kind of an overheat. Right. I mean, if not outright overheat, we grew less than 2%, maybe real GDP in the first quarter, but nominal growth getting a new kick higher. And then what does the Fed do about that?
Yeah, and this is really important because we all, for the last 3 months, have been expecting that there was instead a stagflationary shock coming because of the Middle East. If you take your textbook out and oil prices go up, economic activity should go down and employment should go down. But we are exactly seeing the opposite of stagflation. We're actually seeing overheating because the shock from the Middle East is now being dominated by the AI boom and by the one big beautiful bill. So that's exactly why this dancing between is it stagflation, is it overheating, is looking more like this is overheating in the sense that this is something that the Fed needs to worry more about.
Do you think they will worry more about it? We know some of the members of the Fed will, but I wonder if the intentions of the new chair and the committees cancel themselves out, and we just have to wait and see.
Yeah, so we have 12 voting members on the FOMC. One of them is Kevin Walsh. The other 11 members, and one of them is, of course, Jay Powell, who is now staying on the committee. Yeah. They clearly said at the last FOMC meeting that they did not think it was a good idea to cut interest rates. And we had 3 of them at the last meeting say, well, now they think they should more have a neutral bias. So I think at this meeting, we will probably see them take away the easing bias. And then when we come to the July meeting, they may begin to have a hiking bias if the momentum continues. And that's, of course, where things become more complex because we have, of course, a committee that has been leaning for several years towards, no, rates are going down, rates are going down. And maybe now with the momentum coming from AI spending, from the one big beautiful bill, we also have upward pressure on inflation from tariffs. We also have upward pressure on inflation from energy prices. And we also have upward pressure on inflation because of the AI boom giving more boost, both to wages in those sectors that are benefiting from the AI boom, but also, generally speaking, from prices of equipment, semiconductors. So those 3 forces, tariffs and also, of course, energy prices and the AI boom, they are creating a much more complex challenge for the Fed where they now need to think about later this year whether they maybe have to hike.